Now, to start us off, we are happy to have one of the most influential researchers in macrofinance, Ricardo Reis, to give introductory remarks and set the stage for the topic today. Ricardo, I'll turn it over to you now, and you have 15 minutes.
Okay, great. Thank you very much. Can you just tell me that you're listening to me? Just to make sure. Perfect. Fantastic. Great. Well, thank you everyone for logging in. It's really a pleasure to be here to discuss this topic of what's going on with liquidity, and most importantly, how do we think about them, or how do we want to change the way we think about them given current events? And so the two papers that we're going to have in this session could not be more timely, more exciting, more going after what I think are some of the big questions when it comes to this topic. And so it's really a pleasure to be here. I thought that for these 15 minutes to introduce, I would discuss a little bit of what I think are, make 3 points to discuss what do I think are some of the important questions involving treasuries, central bank digital currency, which are the topics of the two papers. And then thirdly, and related to them, of the interactions that both of these have with fiscal policy, or with the solvency of the government, if you want, insofar as both digital currency by the central bank or treasuries are nothing but state liabilities, which ultimately are backed by the fiscal situation of the government. But let me start with treasuries. For a long time in macrofinance, or in finance, or in macro, we worried, in the sense of we're excited, researched, why is it that treasury yields are just so low? Maybe it's because of the safety they give. Maybe it's because of their liquidity and the easiness with which you can sell them. Maybe it's because they are very much used for collateral, and we develop many theories of why that emerged. But more generally, whether it's safety, liquidity, collateral, that treasuries seem to be special. They were special assets, and we worried about understanding that specialness. Now, some of that specialness was tied to the US dollar. The US has this exorbitant privilege that its currency tends to appreciate in crisis. And so when we speak of, and so that during crisis, money tends to flow to the US. And when we say flow to the US, it doesn't flow to cash, it flows to treasuries in order to earn a little bit of the yield. And so trying to understand what's special about treasuries is in part trying to understand why the dollar is special. We also learned, secondly, that supply matters. Very influential work by Annette Vissing-Jorgens and Arvind Krishnamurti and many others, that seems that the demand curve slopes downward, that changes in supply seems to change that yield. So to try and understand these treasuries, it was important to understand what was driving that supply, that demand curve downwards. And finally, fourthly, aside from why is there a yield, is it tied or driven by the dollar? And third, why is the demand curve for treasury slope down? The financial crisis of 12 years ago taught us, or inspired us, to write a lot of research on the role of regulation. Why is it that so many financial intermediaries need to hold safe assets? And those safe assets are, in most countries, in almost all countries, ultimately the liabilities issued by the government. Regulations of all sorts following the crisis increase the benefits of treasuries insofar as both how liquid, how safe they are, and how much they must be used, not just want to be used, for collateral. In some ways, in the last 10 years, one can jokingly say, partly only jokingly, that while people in finance, they were trying to explain equities, were chasing behavioral factors, research in finance trying to understand bond markets or treasuries was chasing instead regulations. What regulation, the start of which market, how can we use it to test and interpret different theories? Now, these questions are important of which one it is because, in part because, in a more macro perspective, we need to manage the debt. We need to choose how much to issue, at what time, with what rhythm, and that will have large, potentially fiscal costs for the government. Among this, against this backdrop in this setting, March 2020 came along. And so what happened? Well, yields jump up extraordinarily. Even in comparison with OIS rates, there was all of a sudden an inconvenience yield. This in spite of not much happening to inflation expectations or default risk. And it happened very suddenly, as well as once the Fed's actions intervened, we had that it disappeared relatively quickly. Note that if one thinks purely of yields and the fundamentals, it seems surprising that the Fed's actions in April and May and so on were, if anything, inflationary, and yet yields came down, making it unlikely, or at least, or yes, unlikely that this shift in yields was driven by change inflation expectations, because if nothing else, the timing seems to be wrong. Not to mention that direct measures of those expectations don't seem to confirm that. So the yields, we went from discussing why is it that we have such negative yields to all of a sudden the world turned backwards, and we were trying to understand why are the yields so high. Second, the world also turned backwards because the dollar, as opposed to appreciating, depreciated during this time. People took money out of the US, and to a very large extent, approximately 250 billion during that month. All of it, or most of it, in bonds, not bills. So it wasn't quite a complete, say, lack of faith in the US dollar, or in particular, it was not purely just about the role of the dollar, because then you would think they would affect bonds and bills not differentially, and yet it did. Third, there has been an increase in supply in the last decade. The US government has been running very large federal deficits. There's been lots of issuance. Debt to GDP has kept on increasing. So while the supply shot up in March by around 200 billion, still, one would not certainly expect back in February that would have had such a big impact, given how much supply had increased over the previous 10 years. Why now? It seems that the slope, as opposed to the level, is what mattered when it came to the path of that it was about the suddenness of it. Because simply looking at how downward sloping demand for treasuries were from the work that I'd spent 10 years doing this, it's just very hard to understand why those 200 billion made such a big difference. Why was it that? Oh, and finally, when it comes to regulation, when one looks at the needs to hold treasuries on which different banks and others had to hold them, well, all of those, if anything, got relaxed during the crisis. And so, insofar as governments and regulators said they did not want to stop the flow of credit, so if anything, the demand for treasuries should have, the demand for treasuries may in part have declined. So what is it that drove this? Why did these things turn backwards? So the first paper in today's program, or maybe it's the second paper, I forget the order, but the first paper that I'm discussing points to perhaps it was the regulation of treasury dealers. We had an expansion in the supply of bonds that, even though it was only 200 billion, and I say again, only relative to the decade, certainly very large for a month, the key is again the slope in that they didn't have enough balance sheet space. And on top of it, we're facing regulation, particularly hedge fund, and dealing with the hedge funds through the supplementary liability ratio. Oh, I always forget these names of these programs. Dealers required compensation, supplemental leverage ratio, compensation for dealers for balance sheet, as if there was an increase in risk aversion. They write a very nice model, a la Vaiano's Villa, that means that there's an increased volatility in yields, that they need compensation to bear these risks, and on top of it, there's a regulation put into it. Crucial is their data on direct holdings versus reverse repos, and why is it that the different rates changed. So that seems to me like a very plausible hypothesis. But let me put forward three alternatives. One, that maybe demand is just much more volatile, that it's not supply. And the reason why I say this is that 13 months ago, I was puzzling over a different puzzle, which was, why is it that in spite of there being what seemed to be abundant reserves issued by the Federal Reserve, a few disruptions in a few days in September led to an enormous spike up of the federal funds rate. In some ways, that was more surprising than the Treasury's one in March. Why? Because the federal funds rate at a point rose above the discount window, therefore creating a true arbitrage opportunity for some of the banks that had access to the discount window. It seemed that people just all of a sudden went for cash for reasons that research has tried to explain ever since. This desire for cash is large, is volatile. This is consistent with an enormous increase in the demand for cash also in March. And why is it that we didn't see the T-bills yield spike even as people were trying to get out of bonds? So there's something special about cash, about bills, about short maturity government bonds that treasury bonds don't seem to share. There's some enormous desire for it that fluctuates. And that is an alternative explanation to the regulations. Another alternative is that maybe, just maybe, financial intermediaries expect a big financial contraction, and therefore the demand for treasuries will have fallen persistently precisely because of the regulations that were forcing us through multiple channels to hold lots of treasuries to use in order to produce all types of financial contracts. Maybe there is a financial slump, or at least a fear that there was, and so the treasuries are no longer needed. Moreover, insofar as this crisis may lead to the opposite change relative to the previous one. It may lead to financial liberalization opposed to tightening, insofar as governments turn to private credit, both to fund their own liabilities as well as to keep the economy going. Perhaps we just have an expectation that we won't need as much treasuries. And this would be the other side of why we start needing so many more treasuries after 2008. Or maybe it is just because of the expectation that maybe we're heading for a depression and we don't need so much banking or financial business. And then finally, on the role for the dollar. The US over the last couple of years had weaponized the dollar, especially in its relations with Southeast Asia. That may be part of why this time it was not perceived as quite as safe. In particular, and particularly relevant, is the fact that life insurers in Southeast Asia had enormous positions on long-term treasury bonds that they were hedging all the time in the FX market, in the FX swap market. Insofar as that hedging disappeared, and we saw that through a spike in CIP deviations in March, triggering the expansion of the Fed swap lines, maybe this dumping was precisely the fire sale that the swap lines were meant to prevent, and that for a few weeks did not. And maybe the real event in April was indeed the swap lines preventing then the foreigners from having to dump all of these, and thus reestablishing the dollar as a safe asset with a swap line establishing a liquidity. Note, therefore, that what have I done in terms of these expansions? Note my, if you want, rhetorical trick, is that I ended up coming back to precisely the previous four reasons we had discussed before. Insofar as we spent the last 15 years explaining why the Treasury have a positive convenience yield, why the US is special, why regulations increase supply, I gave you alternative explanations for why maybe it was everything is working backwards, but across the different channels. And I think we'll hear more about it from the authors of the paper. Now, aside from the treasuries, there is excitement over the role of central bank digital currency. One side of it is of CBDC as a replacement for physical cash. And the excitement there comes, one, from the competition with private suppliers, but as all with, insofar as central banks do it, there may be a removal of anonymity, which some people may vary, but that comes with discussions on the extent to which it's produced with seniors for privates or publics, the extent to which it allows knowledge and price discrimination if it's privates, and so on. But once you move away from anonymity and cash itself, people have been using digital cash issued by banks for decades. The key for that, for the debit card that I use and all the electronic payments that I make, is that it is backed by deposits of those banks at the central bank. Digital currencies existed forever. It's reserved the central bank, and it's played a fundamental role such that I can say that I use CBDC every day, or better, I use private digital currency backed by a CBDC, the reserves of the banks of the central bank. In that sense, the revolution of CBDC may be less about Bitcoin, say, but more about the fact that more and more non-bank financial institutions can now deposit at the central bank, and therefore payments using it are becoming more, and that payments using it become faster and more efficient. The threat then is not so much to anonymity in the role of the state, but rather to banks, because they bundle their operation of the payment systems with, for instance, the provision of credit. If they lose the provision of the payment system, maybe they will no longer be able to do that. In other words, maybe narrow banks will be on the way, which may actually be good insofar as we're not so worried about failing. Monika and Martin, in the paper they're going to show you, look at a different complementarity, not with lending, or not with lending in the sense of long-term lending, I meant maturity transformation, but rather the extent to which banks, by accepting deposits and managing the payment system, if you want those deposits, have a complementarity with offering credit lines. So if indeed CBDC is all about having non-banks enter this market and compete for the payment systems, insofar as non-banks don't offer credit lines, we may end up with a worse position. Now, this raises important questions. Is this really, this complementarity that they emphasize, is it about at the sector level or at the firm level? Because at the firm level, then we have antitrust considerations to raise, and that is to the extent in which we're letting them abuse this complementarity, or not abuse, earn a rent with this complementarity. Likewise, if we are going to have entrants and we think free entry is important into this market, something that hasn't existed in a long time, free entry in the payment system, and that's, I would argue, the good thing about potentially CBDC, then to what extent can we retain the benefits that Monika and Martin emphasize while preserving some competition, and in particular, allowing for some competition in the banking service? This interacts with treasuries, of course, because whether it's government giving you because the government, now this interacts with treasuries, because the government of course issues bonds but doesn't give you credit lines. So the arguments that Monika make and Martin make would also in some ways inform the previous discussion. Let me conclude. I'm already 1 minute behind time. Apologies. I'll take another minute or two. By then making a third point that interacts with the previous ones. Ultimately, CBDC treasuries are liabilities of the state. Ultimately, they're backed by the fiscal soundness of the state. Now, over the last few months, we've had an enormous fiscal deficit and perspectives that those deficits will stay at least for a while. The debt has exploded all over the advanced economy, not just the US, although let's focus in the US here. Now, how are we going to pay for it? It's a matter of arithmetics that there are three options to pay for it. One is to have unexpected, persistently unexpected inflation. That is very hard to do. A good example is it's almost impossible to buy an option that gives you protection against inflation being more than 5% on average over the next 10 years. Why? Because it's very hard for central banks to manage that. On top of it, insofar as the maturity of the debt in the US is very short, and it is very short and got much shorter, the ability of the Fed to all of a sudden, if the maturity of the debt is 2 or 3 years, as it is now, the ability of the Fed to generate any significant inflation cumulatively over the next 3 years is extremely low in practice. So inflating the debt is really not something that's going to happen, I will predict. Second, in a more polarized political environment, what we know from the work of Alberto Alesina and many others in the political economy is that the chances that we'll have high surpluses to pay for this debt seem very low for the near future, not to mention, of course, the cost of the pandemic. So I'm left with a third option, which is financial repression. Financial repression, in short, can be done in many ways, but I'm defining it here as forcing people to hold treasuries and thus keeping their yield down no matter what. Now, by the way, this also raises the ability to inflate insofar as if you force people to hold treasuries, then 2-year bonds become de facto perpetuities that can be inflated away. Well, repression says that we'll have demand for private CBDC. And the existence of CBDC offered not just by banks, but of the complementarity of the credit lines that Monika and Martin say, may become particularly important in the next few years. Much of CBDC arose as a way to escape capital controls in countries. That was certainly a big boost to Bitcoin and others. Perhaps we'll have a new big boost having to do with escape of financial repression. And finally, on debt. Another way to think about it, and one that has attracted, in my view, perhaps even too much attention, is that perhaps since R is less than G, the interest rate on the debt is less than the growth rate of the economy, perhaps it's just a bubble in the debt, and we can just borrow a lot more without great consequence. Let me conclude, though, meaning we not only we can do a deficit gamble, but also we can have persistent deficits that last forever, financed by the bubble convenience yield of the excited debt. Let me do those some final calculations before I shut up. There's an economic theorem that the maximum sustained public deficit that you can keep as a ratio of the assets in the economy is given by G minus R. Now, if G minus R is 2%, and the stock of assets in the US economy are approximately 2.7 times GDP, capital stock 2.1 times, then international investment position minus 0.5, public debt 1.1, so total assets of roughly 2.7, maybe 3%. That means that if you're going to have persistent deficits funded by a bubble, that bubble will fund 5.4% of GDP deficit at most. Now, the primary public deficit in the last 10 years, excluding 2020, was 4.8%. So if you think you're going to use the bubble to pay for this, well, the bubble gives you an extra 0.6% relative to what you found. Worse, if G minus R falls from 2 to even 1%, that means that the US would have to cut its primary deficit from the 16.7% level of 2020 that we expect by 14 percentage points over the next 10 years in order to respect the budget constraint. In other words, all I've done is tell you that even if public debt can increase by 20, 30, 70% as a result of R being smaller than G, of course, the difference in R and G are also mean that in terms of deficits per annum per year are actually very small. And thus the whole bubble doesn't actually solve the problem and is not an alternative. Thank you very much.
Thanks so much, Ricardo. And Monika, please go ahead.
Thank you. Can you hear me? Okay, great. So thank you very much for inviting me to present this paper. This is joint work with Martin Schneider. So this is about central bank digital currency, which is a vague concept in a rapidly growing literature with many proposals of what central bank digital currency actually should be. And so what it's going to be in this talk, I'm going to define it as interest-bearing reserve accounts for everyone. CBDC is being proposed in a market for liquidity that already exists, where we see bank deposits. These are bonds with an option to sell on demand, and credit lines, which give an option to get a loan on demand. And these products are currently being provided by commercial banks, and they're both important. Let me show you a picture of how large they are as a fraction of GDP. So here you see deposits and credit card limits offered by US commercial banks, and they are both large as a fraction of GDP. So both forms of liquidity provision are important. We view banks as adding value by providing liquidity, and they exploit the complementarity between bank deposits and credit lines. We're going to conclude that CBDC is not complementary to credit lines, and therefore it's only beneficial if it's much cheaper to produce than deposits. So it's unclear whether CBDC is that beneficial. We're going to derive these conclusions from a framework that has preferences in technology as in the neoclassical growth model. So there are households who work and consume goods. Financial markets are complete, and that gives us a representative household. There are competitive firms, and they make capital from goods and also goods from capital and labor. And we put into this frictionless world liquidity constraints. There's going to be buyers of goods. These are households and capital producers who need payment instruments before they buy. They face unpredictable liquidity needs in the sense that only a share V of them gets the chance to buy. And this V in the paper is different across households and capital producers. Here in the talk, I'm going to simplify and make this use the same share V. And then there are sellers of goods. These are the producers of consumption goods. They need payment instruments after selling. It's because they have predictable liquidity needs. They need to store the funds that they receive when they sell, and then they pay wages and rents later. Banks are the providers of these payments instruments. They also need payment instruments to meet customer outflows. So that's the model I'm going to use to derive our conclusions. There are banks that are competitive. So we're looking at competitive banks, and they offer two types of payment instruments: deposits that you can hold before the trade, and you can spend these deposits, and otherwise you keep the rest. Or you can use a credit line that you can draw down to receive a loan if you need it, but you don't use it otherwise. And then banks charge prices per unit of liquidity that they provide. There are two key financial frictions in banks and firms. First, there are collateral constraints. So debt has to be smaller or equal than a fraction phi of the value of assets. And the second financial friction is an asset management service fee, kappa, per unit of assets at price P. To produce these asset management services, that requires capital and labor. And so the goal of society is to keep balance sheets short. And so the idea, the motivation for these asset management services is that whenever you have delegated asset management, there are costs involved of doing that. And this is what these asset management services capture. In terms of capital markets, banks and firms can costlessly adjust equity, and the model is going to endogenously determine the size of banking as a function of preferences in technology. And we're going to assume that these preferences and technologies are such that the capital stock is small in banking. So, banking is small to the overall capital stock in the economy. We could also introduce debt for firms and banks, more additional forms of debt, but because households, banks, and central banks can invest directly in capital in all these assets, there's a version of Ricardian equivalence in Modigliani Miller that is going to hold here, except for trading in liquid instruments. So it doesn't actually matter to the effects that we highlight will go through, even if we add additional forms of debt.
Monika, I'm sorry. I guess my role is to ask a few questions. Is this result that you get that the equilibrium size of banking is small, is that just so that you can match, say, the US, which has large capital markets, or is that necessary? And then how would you think about, say, Europe or Japan, which has much more bank-dependent finance?
So the reason we put this in is to have a model in which the economy doesn't really need to save capital in order to sustain the provision of liquidity. So that was the main modeling goal. But it's also true that in the data, banking is a small share of the overall economy. And so therefore the in terms of thinking of banks relative to the overall capital stock, just in terms of the size, it's smaller. So that was the motivation behind this assumption in all countries. So then we can characterize the equilibrium of this model. So we can solve for the equilibrium allocation as the solution of a planar problem with a resource constraint. And so the resource constraint here has liquidity costs. These are the omegas that are associated with consumption, investment, and output. And these omegas, they're going to depend on the details of the payment system that we're considering. And so in this model, the payment system is going to have real effects, because if the payment system is more costly, that means that we're operating a production technology which is less efficient. And otherwise, the allocation responds as it would in a neoclassical growth model. So for example, it can differ by sector. If you have higher liquidity costs in investment than in consumption, let's say, then the payment system actively discourages investment. And you can think of a banking crisis in our model as just a shift in these liquidity costs. So this acts like a technology shock, and then the allocation responds as it would in a neoclassical growth model to this technology shocks. And so what I'm now going to do is show you these liquidity costs and welfare for different payment systems. And so then I'm going to first start with a payment system where the only thing that banks offer are deposits. So no credit lines and no CBDC yet. So how many deposits are needed to support trade in this model? So there are buyers of goods. These are households and the capital producers. They need to buy stuff. And only a share V of them actually gets to spend deposits to buy. And so that means that buying consumption plus investment requires an amount of deposit that is a multiple of consumption plus investment, and the multiple is 1/V. And that has to happen before trade. So households and capital producers need this aggregate amount of deposits before they trade. That is because their liquidity needs are unpredictable. That leads to precautionary deposit holdings. So this share 1/V is larger than 1. Those are the precautionary deposit holdings. The sellers, they're producers of goods. They sell consumption plus investment goods. And that requires deposits V times D, which is the total amount of consumption plus investment after trade. And so who trades with whom here, and how do banks manage their liquidity needs? So here there are many identical banks, household, and firms. All interbank flows wash out. That's what's happened here. So the assumption is that bank liquidity constraints don't bind. So if we wanted to add interbank liquidity flows, we would need to introduce explicitly liquidity shocks of individual banks, and then model their reserve holdings and an interbank market for trading reserves, for lending and borrowing reserves. We did that in earlier work, but it's not really important for what I'm going to show you today. So let's look at balance sheets once we have purchases by buyers from sellers. So buyers own deposits. So assets are in green and liabilities are in red. So they have deposits before the trade. After the trade, they spend a share V of these deposits. That becomes an asset of the seller. And bank deposits stay unchanged because they just migrate from the asset side of the buyer to the asset side of sellers. To think about the liquidity costs associated with this trade, let's think about the liquidity costs associated with that. So we have 2 minus V time divided by V many deposits. They require assets 1/5 to back these deposits. These asset holdings come with an asset management fee kappa, which costs P. So these are the liquidity costs of consumption. If you look at if who's buying is a capital producer, you have to add asset management fees kappa I because they have to hold deposits before they purchase, and that creates liquidity costs. And then there is a liquidity cost also associated with selling output that it just is an asset management fee associated with these deposit holdings. And so here, the resource constraint for the equivalent planner problem when banks only offer deposits looks like this. And you can see that the property of banking with deposits is that liquidity costs are high if liquidity costs needs are unpredictable. So if V is small, if liquidity needs are unpredictable, that generates a lot of precautionary deposit holdings, and that generates a lot of asset management fees that represent liquidity costs. And the investment is extra costly because firms are not natural savers. They have themselves balance sheet costs, kappa I, that generate liquidity costs. So this is for the case just with deposits. Let me add credit lines to the model. So how many deposits and credit lines are needed to support trade in this model? So here, the buyers of the goods, we're going to solve for an equilibrium in which they only use credit lines because they have this unpredictable liquidity needs. Buying consumption plus investment is cheaper if they do that by arranging for a credit limit before the trade. The credit limit is just the amount of, before they were using deposits, which was a multiple 1/V of consumption plus investment. Now this is a credit limit. And actual loans that are drawn down are just V times L. That's just consumption plus investment. So in this world, their buyers of the goods don't have precautionary deposit holdings anymore. They just arrange for credit limits and then draw down these credit lines. The sellers sell consumption plus investments, but still they need to hold deposits after trade. And that's a fraction V of D, that it's consumption plus investment. So how does this look like? So in a world with credit lines, buyers find it cheaper to just draw down their credit line, V times L. That becomes an asset of the seller. And also, therefore, the drawn credit line becomes an asset of the bank, while at the same time, the deposit of the seller becomes a liability of the bank. So now the bank has VL on both sides, but VL is not the drawn down loans are not sufficient to back deposits because they have to be backed by more assets, a fraction 1/phi, phi is smaller than 1. So banks need to hold additional assets, and that's capital. So they add capital holdings, which they back with equity. What are the liquidity costs in this model? There's no liquidity costs associated with consumption and investment, but there's now liquidity costs associated with selling. And that's because the sellers, firms that sell consumption goods, have asset management fees associated with the deposits that they receive. And so this is the size of their liquidity costs. Let's compare the world with and without credit lines. So the first line is the omegas that are associated with credit lines, and the second line is just deposits. And so now you see that credit lines come with welfare gains. That's because they avoid precautionary holdings of deposits, and that looks like higher TFP. Also, they avoid firms' balance sheet costs because firms are not natural savers. The capital good producers get away with just using credit lines, and that is investment-specific technological progress, which increases investment in this model. The two products, deposits and credit lines, they're complementary because the drawn credit line is an asset that backs deposits, and that looks like higher TFP in this model. And so the importance here is that this complementarity is due to collateral savings by banks. It's not because this complementarity somehow helps a liquidity constraint of banks. It's just savings in terms of overall collateral asset that banks have to hold. So what happens if a central bank comes into this world with deposits and credit lines and offers central bank digital currency? We're going to assume that the central bank is just like another firm. It has a maximal leverage parameter phi star and asset management cost kappa star itself. And then it will offer CBDC at marginal cost. So that's what we're going to assume. The central bank comes in and offers these deposits. And there are two simple results that we can see right away. CBDC will be good only if the technology that the central bank has is really better. So the welfare gains require that the ratio of kappa star to phi star that the central bank has is strictly smaller than the kappa and the phi that banks have, that commercial banks have. So either for CBDC to be good and preferable in welfare sense, it either has to come with cheaper asset management that the central bank has, and that seems plausible, or there's a better ability to commit that the central bank has. So either one is needed for CBDC to be desirable. Another result is that CBDC is good if the technology is better and banks only offer deposits. So in a world with only deposits, it's clear that that it's great to have CBDC if the technology is better, because then all depositors just migrate to the central bank. Commercial banks will disappear in our world because they have no value beyond liquidity provision. They're not important for making loans in our world. We have a liability-centric view of banks that views them as important as liquidity provider. And that means investment actually in our model increases once deposits migrate to the central bank because liquidity has become cheaper. And so these results are easy to derive. The question is, what happens if banks also offer credit lines? So what if CBDC is added to a world where banks also offer credit lines? So now buyers and sellers face a choice of payment instruments if the world has deposits and credit lines and CBDC. And so suppose deposits and CBDC are priced the same so that bank customers are indifferent between these two products. But buyers will still use credit lines. So we're in a world in which the liquidity needs are unpredictable and the technology of the central bank is not too great so that CBDC is not that cheap that even buyers switch to CBDC. In the paper, we also analyzed the case when households stop using credit lines altogether. But let's assume that the buyers still use credit lines. Then the response by commercial banks to this entry by the central bank with CBDC is to still issue deposits. They match the higher interest rate that CBDC earns. They increase the price of credit lines to break even. And that is associated with high funding costs for banks. So it's no longer profitable for them to invest in other capital. So bank assets will be just the loans from the drawn credit lines. That will be their only asset. And there will be a deposit outflow to CBDC. And there's going to be liquidity costs for banks because they face now their own liquidity constraint because of these deposit outflows to the central bank. Banks themselves have to hold CBDC before the trade. And so let's look at the balance sheets, how this looks like. So here buyers still pay sellers with drawn credit lines that become assets on the back of banks. And it will also generate deposits, but banks will only keep a fraction phi of these assets as deposits. The rest will migrate to the central bank. And to prepare for these outflows of deposits, banks will start holding central bank digital currency before the trade happens so that they can accommodate these outflows. And now we can sum up together. So the resource constraint now looks much messier. I will spare you the equation and just tell you the main result is that CBDC in a world with bank deposits and credit lines improves welfare if and only if the central bank technology, so Kappa star over Phi star is much smaller than the technology, or is much more efficient than the technology that banks use. And the expression here tells you how much more efficient the central bank digital currency has to be. So it has to be sufficiently cheap to offset the cost of the credit line, which is basically higher TFB. If the central bank is only marginally more efficient than central bank, CBDC reduces welfare in this world. And so one of the questions is, can central banks actually help the asset side, keep the asset side of the banks unchanged if they offer a credit line to banks and so bridge this deposit outflow? And the answer is that no, actually, by offering a credit line, that generates also higher liquidity costs. So let me skip this. Let me repeat the overall message is that CBDC here was interest-bearing reserve accounts for everyone. When they enter into a market for liquidity that has not only deposits, but also credit lines, then it's not clear that CBDC is beneficial. It's beneficial only if it's much cheaper to produce than deposits. Thank you.
Can I ask you a quick question before I go to discussion? I presume that these kind of qualitative lessons would continue if you thought about the fact that intermediate transactions, not just final transactions, require liquidity, and that we have a gross volume of transactions in asset markets that also require liquidity to settle. I mean, your model is focused on final transactions, but I assume these types of considerations would go through.
Yes, I think so too, yes.
Okay. Well, then, thank you. That was very clear. I'll go to my discussion, if that's all right. All right. So, hopefully everyone sees this. Is that a thumbs up? Excellent. So thank you for asking me to discuss this paper. I enjoyed it. It brought back issues that I encountered when I first arrived as an assistant professor at Chicago with Bob Lucas when we taught a course on the transactions demand for money. So it was very enjoyable for me to read. One of the first points I want to make just right off the bat, I wasn't as aware of this as perhaps I should be. Bank customers really do like to use credit lines. This is from an FDIC survey they do annually, and how households use banking and financial services. And we see here that for households with over $75,000 in annual income, 80+% of them, 90%, depending on race, are using credit lines as well as being a bank customer. So I do think Monika and Martin are pointing to something important, that banks are offering sort of a bundled package of financial services. But in terms of my discussion, I'd like to provoke a conversation First of, can this model be used to assess what happened with money market mutual funds? You don't need a central bank digital currency to come into competition with banks. We already had in the US starting in the 1970s, money market mutual funds coming in. And of course, they do not offer credit lines. So I'll say a few words about that. Maybe we can take that up in the general discussion. And then I'm going to reveal myself to be a dinosaur. I feel like perhaps I'm a shareholder in Barnes and Noble in the mid 1990s when Amazon comes on, and I say, is it really plausible that they'll wipe out bookstores? And I'm going to say no. And then I'll say there's something else I think that is very important that hasn't been discussed. The act of settling payments attracts a lot of revenue and a lot of profits. And that has not been discussed in this model. That is a bundled financial service that is in competition. Banks are now in competition with non-bank providers. And so there's questions of like, one role of a CBDC would be to improve settlement. And just, we can talk in the Q of A of how would you put that in the model. So just first, money market mutual funds came in the 1970s, probably a product of regulation. I'm showing here the assets in money market mutual funds, both retail and institutional, relative to M2. So, they've taken a substantial share of the market, different from what Monika and Martin discussed. Money market mutual funds are probably at least got their entree into this business because of regulation rather than some inherent cost advantage. And Monika and Martin mentioned in the paper that if the central bank digital currency did attract a lot of deposits, it would, in some sense, then become an important source of funding for banks. And we actually have seen that with money market mutual funds. So then we have kind of, we're scaling up the asset management costs by running it through the money market mutual funds. And because money market mutual funds don't directly offer this bundled package with credit lines, through the mechanisms they've discussed in their model, we should have seen then a growth of excess liquidity in the system. So as a historical exercise, rather than as a projection about central bank digital currencies, it seems that one could use a model along these lines, perhaps, with other features added to make it kind of more quantitative, to ask a question retrospectively, socially, what did we lose by having money market mutual funds introduced? But let me go to this issue about central bank digital currencies. And is it plausible that they're going to compete directly with banks for deposits? Ricardo already mentioned in his introductory remarks that we have a central bank digital currency. It's called reserves, and our access to it is intermediated through banks. And if you actually think about physical currency, if you want to take your torn dollar bill, or you want to, your supermarket and you want to get rid of your cash, our access to physical currency is also intermediated through banks. And I think that, here I'm being the dinosaur in favor of brick and mortar. It takes labor and physical capital to market and provide financial services to consumers and firms. And I just don't see central banks as being in a position to do that. So let me be a little bit more explicit about that. This is a table that shows you the number of branches that major banks have. We have, for the top banks here, we have 4,000 or 5,000 branches. And then we do have a couple of exceptions. Charles Schwab and Morgan Stanley don't have branches, but, I'm somebody who has used a brokerage account for 30 years as my primary financial instrument. And Charles Schwab does have a lot of offices. They're just not bank branches that you can go into. Fidelity has them too. Goldman Sachs is trying to market an online-only bank, but you see that so far, their total deposits are pretty small relative to what we see up here. And Goldman Sachs, of course, is bundling other financial services to high net worth individuals, through this Marcus Bank that they have. Another feature is that, banks employ hundreds of thousands of people. And, the Federal Reserve System, their total employment, I think, is 23,000. So unless we're going to see some substantial increase in employment in the central bank, or unless the central bank has some magic wand that they can say, oh, you guys were wasting your time hiring all these people and building all these branches, I'm a little skeptical that they'll be able to attract directly substantial deposits. It's also true that, we talk about, there's a lot of literature on the deposit channel of monetary policy and the rest, and imperfect competition in banking. In the data, banks do obtain substantial, what I'll call quasi rents from their deposit base. So what is in this graph is an attempt to measure those quasi rents. Mercer Capital reports regularly on what they call core deposit intangible values. So what's going on here is when one bank buys another, when it buys the branches of another bank, they usually pay over book value. And so in the accounting of that merger transaction, they have to attribute some of the goodwill, the excess of purchase price over book value, to various, categories. And one of the categories is what they call the deposit intangible value. Is just the fact that the cost of deposits is less than the cost of market funding for a bank. And so we see that these things are about between 1% and 2% of the total stock of deposits. So these are rather substantial. So the model of banking I have in my mind, or the model of the provision of financial services, it's not unique to banking, is that you have to invest, like any business, in a marketing effort and a physical presence and a service effort to attract then what is to you as a bank a profitable financial line of business. And unless the central bank is going to be like Amazon and really kind of try to be a business, I don't see it as being able to enter into this market. The other issue I mentioned is this thing about payments versus liquidity services. I mean, one of the things you get when you bank is an ability to settle transactions. And it is true with money market mutual funds that if you want to actually, write a check or pay a bill, your account or Fidelity is providing those services through a bank. I think State Street is a particular bank that does a lot of this and earns a lot of revenue. And one thing about payment services, the central bank does have what I'll call an unfair advantage, but a true advantage in providing credit to support payment settlements. If you think, for instance, about Fedwire, where they guarantee all intraday credit between banks, there's quite a lot of credit being provided. At the retail level, Visa and MasterCard are providing this credit when a merchant gets an authorization. The merchant knows he or she is going to be paid, even though the bank that issued the credit card doesn't know yet that the consumer is going to pay the bill. So Visa steps in there and has arrangement with banks to do that. I guess conceptually, the central bank could provide this type of intraday or settlement credit associated with settlements. At the retail level, this would seem to be a pretty risky business for the central bank to get into. But I do think, it's worth thinking more carefully about what payment settlement innovations a central bank could bring about relative to what we already have. I mean, not only do we have Fedwire, but the Fed introduced some time ago the ACH payment system, trying to get into the, simplify the check clearing business, and perhaps that they can do more. But, I'll get to this question of why are Square and PayPal so valuable, because I think that I don't understand, and I think that this is really the key issue to think about what a central bank digital currency might do in the payments arena. So this is just data I wanted to use to provoke thought about where do banks get their revenues connected to the provision of payments and liquidity services. So this is a chart from McKinsey Global Payments Report, an annual report on the kind of payments business. And we have columns, Asia Pacific, North America, Europe, and Latin America. And we have these bars are divided. The gray bars refer to what's going on with consumer accounts, and the blue stuff at the top is referring to what's going on with commercial accounts. These numbers across the top give you total revenue in billions. And let's just take North America. So on the consumer side, the provision of credit through credit cards is a very large portion of the revenue. Domestic transactions, these are basically settlement fees, are another large portion of revenue. And then what they call account-related liquidity, which would be the gap between, say, a market interest rate and a deposit rate, is relatively small. And then, of course, you have cross-border transactions, which are super expensive, and you have the corresponding items for commercial accounts. So kind of the key lesson I want to take from this graph is, you know, around the globe, transactions processing, you know, there is true that the interest rate you earn on liquidity services can be important. Here we have in Asia, but transactions processing is a very big part of bank revenue. And this is something that's kind of not discussed in the paper. Another fact that I find very striking is this comparison of the market capitalization of banks versus payments providers. So this is an estimate of the total market cap of 4 large payment companies, Visa, MasterCard, Square, and PayPal, so a little over $1 trillion. And this is the total market cap of the 6 big banks, being JP Morgan, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, and Goldman Sachs. And even more remarkable, you know, these payments companies basically don't have balance sheets. So they're trading at market to book like about 30. And the banks are trading at market to book well under 1. So, you know, there is this question, and I think an important area to understand, there's something really profitable, high revenue and high profits in processing payments. Are these things rents? Are they quasi-rents? Could a central bank digital currency do something about this market if these things are rents? I think that these are kind of central questions to push this discussion further. So I just might summarize and open it up to Q&A. I think it's a huge contribution of this paper to focus on banking as a business. I just want to stress, banks hire hundreds of thousands of people and have thousands and thousands of branches. You know, they're kind of like the pizza business. So I ask myself, like, would a central bank want to get into that business? I do think, though, and this model can also have a big contribution both for historical work relative to money market mutual funds, currently on the development of fintech non-bank payments providers, and going forward, you know, as technology develops, what do we want to do? But I want to stress that kind of the central contribution, people have to start thinking about this as a business. It's kind of like making steel or cars, and we have to think about the IO of it that way. All right, so thank you.
Thanks a lot, Andy and Monika. Before I ask Monika to answer any comments or responses to Andy, so to the audience, please raise your hands if you have any questions or if you would like to participate. We would love you to participate in the general Q&A. So Monika, please, if you have anything to discuss with Andy.
First, I wanted to thank Andy for an awesome discussion. These are really great comments. I agree with Andy that I think the model is useful to think about the introduction of money market mutual funds. The way I think about that is that there was sort of, when they arrived in the 1970s, Regulation Q was in place. And so there basically, we would have to apply the model in a situation where banks were not allowed to match the interest rate that money market mutual funds were paying. So we would need to introduce an interest rate cap on deposits by banks into the model. And then what we would see in equilibrium is that the deposits would outflow to the money market mutual funds, and banks' credit lines would get more expensive because funding costs for banks would go up. And that's, when I look at the data, I feel like we saw that. We saw in disintermediation of the banking system. We saw a shrinkage of the banking sector in the 1970s when money market mutual funds grew. And so then the welfare effects of the introduction of these money market mutual funds depends on how many people prefer to use credit lines as opposed to deposits, because credit lines became more expensive. And then today, the situation without regulation, we have basically this, I compare this with the entrance of an institution that doesn't have a technological advantage. And then this situation today is also interesting to think about stable coins like Libra, which I think of as glorified money market funds. In this situation today where banks are able to match interest rates and the entrance doesn't have a technological advantage, in our model, there would be multiple equilibria. Customers would be indifferent between all these deposits, and the model is perfectly fine with the coexistence of these different instruments. There would be inefficiencies if credit line providers were required to hold more liquid funds to make sure that when customers of these different devices pay each other, if banks have to hold liquidity to make sure that they can accommodate all these liquidity movements, that is inefficient in our setup. The other very interesting thing that Andy raised is this custodian relationship between money market funds and banks. In the US, money market funds don't have access to FedWire, only their custodian banks do. And that's a high fee business for banks to provide these custodian accounts. And so then the question is, would it be better to think of money market mutual funds as one combined entity with commercial banks? Because basically they combine, we think of them as basically circumventing regulation. Is that how we should have them in the model? Andy raised this issue of Visa and MasterCard and their market cap, and also them as financial intermediaries. The way I think about them in our model is that they provide an intermediate input for banks. They provide basically the Visa payment network that banks have to buy in order to provide credit cards. And so the drawn credit lines are on the balance sheets of the banks, while the bank is only buying these, the network, the paying network from Visa and MasterCard. To the extent, as Andy was raised, to the extent that there is limited competition in the provision of this of these networks to banks, then it's interesting to think about rents in that sector and how that would interact with a CBDC, and more generally, monopoly power. So monopoly power of banks in the deposit markets is going to favor the introduction of CBDC. So this is going to be an argument in favor of CBDC. In fact, there's a paper by David Anolfato that analyzes that what happens when CBDC competes with banks, and banks have a deposit market power and deposits. The number of branches, I'm not as worried about those as Andy is, because the number of branches of banks have been coming down. Customers go to the branch when they open an account. So that's what they used to do in the past. Now they open their account on the internet. People go to branches when they want advice about asset management. And so it's not really associated with I don't view the presence of branches as there to support the deposit business, but they are to support other functions that banks have, like asset management.
I agree with almost everything that you say, except for the last point. I recently had an experience where Fidelity debited the same check from my account twice. And it took me 2 days on the phone, including with the person to whom the check was addressed, to get one of those transactions reversed. I picture myself talking to a bureaucrat in a central bank, trying to understand if they'd made an error in debiting my account, how I would ever fix it. So I'll just say that even if you don't need a branch, you still need service personnel when stuff goes wrong.
I mean, I would add also, by the way, Andy, I mean, there's another element to that, which is, money laundering legislation requires you that when you take a deposit also to check the customer and so on. So there are costs that will take. So, but I don't think CBDC, and this is the point that Monika and Martin are making, is CBDC is not about the commercial side of I can go and open an account. Like I said, I mean, I can see an enormous margin of intermediaries that will offer that service for me. They have the branches. The key is they can deposit central bank, settle the central bank, and then can they or not offer the credit lines that Monika said. So I thought your money market funds is kind of the right analogy, but the using of the branches, I don't think any central bank thinks that they're going to have do the simple document verification for New York customer and money laundering. No central bank has the ability to do that, I think.
No, but so then Ricardo, I think that, so Square's a good example. Square wants to get into the provision of credit lines to businesses because they feel that once they have the sales data, so I could see fintech firms, in other words, if you're telling me that a central bank digital currency is about enabling non-bank intermediaries to provide the same bundle of services that Monika and Martin are discussing, which is, credit lines and payment services and liquidity. Well, Square is not offering deposits, but they, then I'm like, sure, you're just basically handing out more bank charters. It's not really about a central bank digital currency. It's about who can get a bank charter. And I think that I interpreted Monika and Martin as discussing, and others as discussing, you would go direct to the customer as a central bank.
Okay, guys, this is a really cool discussion. We're all like absorbed, but I want to ask some questions from the audience. So let me go there. So the first question is from Juan Carlos Zambrano from my own university, Ireland. Juan Carlos, please.
Oh, can you hear me?
Yes.
Perfect. I just wrote a question regarding the technology factor, because it seems it's in the Monika's model, it seems that this is something that plays a role in if the central banks should do the payment system to see if it should do the CBDC. But my question is how in the model, how do you consider the competition in terms of technology with the providers of the technology that are basically trying to make a more distributed market rather than a centralized model?
Do you want one question at a time, or do you want to accumulate questions, Mary?
No, I would say, so let me ask, we're kind of running out of time, so let me ask one more question. Pierre Olivier had a question from UCLA. So Pierre Olivier, do you want to ask? And then Monika, you should answer. We have more questions, but you won't have time for them.
Hi. Hi, everyone. Hi, Monika. I just wanted to ask a clarification about the precise mechanism that makes deposits and credit lines complement, and what's the empirical or theoretical support for that?
So the way it works in the model is that so banks have to back deposits with assets. That's the key assumption. And if they also offer credit lines, the drawn credit lines become an asset that backs deposits. And so in terms of thinking about liquidity provision, the cheapest way to provide the most liquidity is to offer deposits and then back them with drawn credit lines. That saves on balance sheet costs and still respects the collateral constraint. And so the way I think about collateral constraints is that any firm that wants to issue debt and wants to convince its investors that they're going to repay the debt, it will have to put down some collateral. And the desire to keep the balance sheet short is that there's some costs associated with having delegated asset management, either some moral hazard or some other costs that are associated with having somebody else manage your assets. Right, you want to?
Okay, great. Thanks a lot, Monika. Thanks a lot, Pierre-Olivier. So we have many more interesting questions coming in, but unfortunately, we have to move to the next talk. So just for a reminder, we're going to have the virtual chat on Wonder platform after the second Q&A that we can pursue all of these discussions. And the link will be posted on Zoom. So now we turn to Stefan Nagel. Stefan, please.
Can you all see the slides and hear me?
Yes.
Yeah, okay. So this paper is a joint work with Jigao He and with Jiaguang Song, who is also here as a panelist today. And what we're trying to understand in this paper is something that Ricardo already alluded to earlier in his introduction, that there was something really unusual going on in the Treasury market in March 2020. Right, so the usual playbook that we saw in various crises in the past decades was if some trouble hits global markets, then Treasury yields fall. And everybody runs into Treasuries, buys Treasuries, pushes up the price and down the yields. And in March 2020, this is what happened initially. So the red line here is the 10-year Treasury yield. The blue line is the 3-month yield. And you see that long-term Treasury yields initially fell, but closer to middle of March, something changed and Treasury yields actually started rising, which is a very unusual and puzzling pattern. And, what we're trying to figure out is, why was it different this time? Why did Treasuries behave so differently from previous crises? One possibility is that, in a way, what we saw there, these movements in Treasury yields could be something like a canary in a coal mine, that something fundamentally changed about Treasuries, that they are no longer a negative beta asset or a flight to safety target asset, but investors view them fundamentally differently now. The other, and this is not necessarily a different explanation, but something that could also be playing in, is that there was market dysfunctionality going on. There was something in the operations of the market that exacerbated the effects of supply and demand shock in the market. Yeah? And our analysis is really focusing on this second possibility, and we'll have something to say about this, that this played some role. But of course, this does not rule out that something fundamentally also changed about Treasuries. But as I will show you today, at least, there's not much in the data that we can see that would support this, kind of fundamental change explanation. But the way we see it is that the jury on this is still out at this point. So here's a roadmap of what I'm going to talk about. I'm going to start with some motivating evidence on some supply and demand factors and some rate movements, and then I'm going to discuss a model of the Treasury yield curve that's based on a preferred habitat model, where we're going to introduce an intermediation friction in the repo market. And this model is going to give us some additional predictions about what sort of rate movements and spread movements we should see in 2020 if these intermediation frictions are relevant. And I'm going to show you data on this. And then if there's time at the end, I can say a few words about what our model would say about the 2008 crisis. And it turns out that the same kind of model with a little twist is actually also informative about movements in yields and rates and so on in 2008. Okay, so if you were worried about in a way, a fundamental story of why Treasury bonds are viewed differently by investors, I guess the first place to look for would be inflation expectations and inflation uncertainty. And there the story is basically that not much happened in March 2020. If anything, inflation expectations fell throughout March 2020. So the red line here is inflation swap rates. The dashed line is break-even inflation rates extracted from TIPS. And if anything, they fell. So this doesn't help explain why yields went up in that period between these two last vertical lines here. If you look at inflation uncertainty measures from the Minneapolis Fed, same story. There's no evidence that, for example, tail expectations about inflation somehow became more important in that period. So then let's look at supply factors. One source of supply of additional treasuries in this March 2020 period was issuance by the US Treasury. And in March, they were actually issuing quite a lot, about $150 billion. At the same time, we also saw some groups of investors engage in large sales. For example, foreign investors, they sold a total of about $300 billion within 1 month in March 2020. Domestic investors were also selling, some of them. The green bar here is mutual funds. They sold about $240 billion in the first quarter of 2020. Now, who could take up this supply, at least temporarily? Well, the first place to look would be primary dealers. And if you look at their balance sheet, you can actually see that they initially did take up some supply. So here's the balance sheet of primary dealers in terms of net treasury holdings on the left-hand side. And you can see that until March 9th, there was an increase of about $50 billion or so in their holdings of coupon treasuries. But then after March 9th, it kind of flattened out. There wasn't much increase anymore. One thing that dealers also do is, instead of holding a treasury directly themselves, they can provide repo financing to other investors, hedge funds, for example, to buy these treasuries. And dealers did quite a lot of this. So you can see here is the reverse repo position of the dealer sector. And there was a huge increase of hundreds of billions of dollars. But then sometime in mid of March, this also flattened out. Okay, so if you do some rough back of the envelope calculation, what we have here is a bunch of sources of additional supply thrown on the market, somewhere north of $700 billion. And it was temporarily absorbed by dealers directly, about 50 billion, and by repo financing provided by dealers, 400 billion. And there's still a gap. We don't quite know where the rest of this went. But we do know what eventually happened when the crisis was in a way kind of resolved. It was the Fed that stepped in, and in late March, the Fed started buying treasuries big time, and eventually they ended up with more, more than an additional $1 trillion of treasuries on the Fed balance sheet. And at least based on what we see so far, this was basically a permanent change. So they took these treasuries permanently off the market, at least so far. Okay, so we have a situation here where there was basically a significant shift in treasury supply, where some investors got out and other investors had to absorb, and we did not see a very elastic response by intermediaries and other investors. And so we're going to try to explain this lack of elastic response with a model in which dealer banks are facing a balance sheet constraint. Yeah? And we're going to get some predictions out of this. For example, if there's a supply shock of this kind and dealers have this balance sheet constraint, we should see a steepening yield curve. We should see treasuries trading at an inconvenience yield, which means they should have a higher yield than a frictionless interest rate that we can try to measure with derivative contracts. And there should be repo rate spreads. And I'm going to show you later some data both on these inconvenience yields and also on these repo rate spreads. Okay, so the model is basically an extension of the preferred habitat model of Greenwood and Vallanos. And in Greenwood and Vallanos, there are two types of investors. There are habitat investors that like to be in a certain place on the yield curve with their holdings. And there are arbitrageurs that are basically providing liquidity to these habitat investors. What we do in our model is we take these arbitrageurs and we split them into two types of investors. On the one hand, levered investors, you can think of them as hedge funds, and there's dealers. And there's a link between the two, which is the repo financing that dealers provide to hedge funds. Okay, so we end up with three groups of investors. Habitat investors that are gonna face an exogenous demand or supply shocks at a certain point on the yield curve. There's gonna be these levered investors that are gonna hold treasury bonds with repo financing provided by the dealers. And there's gonna be dealers that can either hold treasury bonds directly or provide repo financing to these levered investors. Okay, and that's going to be in a way two frictions or two forces that are going to inhibit in a way arbitrage by levered investors and by dealers. First of all, dealers and levered investors are going to be risk averse, so they're going to demand a premium for carrying risk on their balance sheet, and the dealers are going to face a supplementary leverage ratio, which we're going to implement by having basically a shadow cost of using up balance sheet space. And the important thing will be in the model, and this is consistent with the regulatory environment, that dealers balance sheet space is going to be consumed not only by direct holdings of treasuries on the balance sheet, but also by the repo financing that they provide to levered investors. So if they lend, if they make a loan against treasury collateral, that's also going to add to their balance sheet, and that's going to affect their leverage ratio. Okay, so a quick sketch of how the model looks like. There is some interest rate risk. This basically comes from a stochastic short rate process. There's going to be habitat agents that have, as I mentioned earlier already, exogenous holdings subject to some shocks. And the way we have modeled these shocks are as follows. There's basically these beta shocks, and they are multiplied by some theta function. And the theta function basically just determines on which part of the yield curve these shocks are going to hit. Yeah? And we're going to have this in the baseline version of the model, very simple. When we, to analyze the March 2020 period, we're basically going to say the shock hits for long-term treasuries, starting from a certain point on the yield curve for all longer maturity bonds. Okay, and then these levered investors are basically mean variance investors. And the key thing really just to take away from this here is that they will face a financing cost, this capital R, which is the repo rate that dealers are going to charge them when these levered investors want repo financing from dealers. So this capital R is going to be crucial. And this capital R will be determined in equilibrium. And if R is higher, this is going to reduce these hedge funds' demand for levered positions in treasuries. Dealers are also going to have the same kind of objective, mean variance, and they're going to hold treasuries directly, or they can provide repo financing to these levered investors. And the dealers also finance themselves. We assume that they can finance themselves at the riskless, frictionless rate, small r, and they're going to charge levered investors this capital R, and there could be a spread between the two that's determined in equilibrium. Now, where does the spread come from in equilibrium? It comes from the balance sheet cost. Yeah, so when dealers look at their objective, there's going to be a balance sheet cost floating around here that they want compensation for. And so the key thing will be what determines this balance sheet cost? How is this modeled? We're going to specify the balance sheet cost as a function of the aggregated dealer balance sheet in the economy, and it's going to be increasing. Yeah? And you can think of this as, the dealers are basically shifting around holdings among themselves to basically optimally, allocate given these costs among themselves. But the more the aggregate dealer sector is forced to absorb on the balance sheet, the higher is going to be the marginal cost of an additional unit of balance sheet. Yeah? And we motivate this with the supplementary leverage ratio plus basically a cost of raising equity, so that they cannot just get around, at least in the short run, this leverage ratio constraint by just raising a lot of equity. Okay, And the key thing again is that the balance sheet space will be consumed by direct holdings of the dealers, as well as the repo financing that they provide to hedge funds. And the balance sheet cost is then going to be, the marginal cost is going to be linear in the aggregate size of the dealer balance sheets. Okay, and then how does equilibrium play out here? We're going to normalize the aggregate bond supply to 0. And then markets have to clear. So the Treasury market has to clear, which means habitat investor holdings and repo financed investments by hedge funds and direct dealer holdings all have to add up to 0. And then the repo market has to clear. So whatever hedge funds want in repo is what the dealers provide. Okay. And so the key thing really of what's going on here in the model then is that when the hedge fund sector buys bonds from dealers with repo financing, this helps them to share risks with the dealer sector, but it's not going to relax the dealer's balance sheet constraint because the repo is still going to show up on the dealer's balance sheet. Okay, and then in equilibrium, it has to be the case that the dealer and hedge fund marginal holding costs are equalized. This means the repo spread that dealers charge is equal to the marginal balance sheet cost. Okay, now we can think about what happens when a shock hits the markets. So let's say there's a shock to habitat investors holdings. They don't want treasuries anymore. So it's gonna be, it will have to be the case that hedge funds and dealers jointly hold these treasuries. How they're gonna hold them? Well, they're gonna optimally share the risk between themselves and determine, who holds how much. But whenever the hedge funds hold something, they are going to need repo financing for that. And so the balance sheet cost is going to be affected by the total size of the shock, not just by the direct holdings of the dealers, but by the entire size of the shock that has to be absorbed either by direct dealer holdings or by repo financed holdings by treasuries, by hedge funds. Okay. All right. And let's now look at some data on this. Yeah. So what our model now makes two predictions in a way that, something that should be true if this story that we were telling about these intermediation frictions is relevant. We should see that in a time when dealers are really, dealers' balance sheets kind of get tight, then we should see that this repo spread goes up. And how are we going to measure this? So we basically want the difference between the rate at which dealers can borrow sort of frictionlessly and the rate that they're going to charge hedge funds when they lend. We cannot directly observe this, but what we can observe is the rate in the GCF repo market, which is a market where, for the most part, large dealers lend to small dealers. And we can look at the tri-party repo rate, which is, for the most part, the rate at which money market funds lend to large dealers. And so we basically get, the rate that dealers pay when stuff comes into large dealers, and we get the rate at which money flows out of the dealers. And we look at the spread between the two. The other prediction is about the Treasury inconvenience yield. So when these supply shocks, big supply shocks hit the dealer/levered investor sector, we should see that the Treasury start trading at an inconvenience yield. And this basically means that if we were to compare the Treasury yield to the implied yields of a derivative that pays the same cash flows as a physical Treasury, but is not subject to these balance sheet costs, then we should say a spread between the two, where the Treasury yield is higher than the yield implied by this derivative. Yeah? And we do this by looking at overnight index swaps and comparing them with Treasury yields. And it's not true that swaps have zero balance sheet costs in practice, but it's very close to being true. So the balance sheet cost is orders of magnitude smaller than for directly held treasuries, or for repo for that matter. Okay, so I basically said this verbally. Let's look at the data on this. So red line here in the left-hand plot is the Treasury OIS spread at a 10-year maturity. And you can see coming into 2020, this was already positive, consistent with there already being some balance sheet costs that dealers basically want to be compensated for. And when we hit this critical period in March 9 in this year, the spread started dramatically shooting up, and it reached levels of about 50 basis points. And then eventually, once the Fed started intervening and so forth, it basically came back down. And this is really something that's happening mostly at the long end of the treasuries. If you look at the shorter end for 3-month maturities, this is the dashed line at the bottom. You can see this was actually very close to zero. There are also some blips around, but it doesn't have this feature of being persistently positive as at the long end. The right-hand plot is what happens to the repo spread. So you can see that there was a huge spike in this critical period in the second half of March 2020, when this repo spread blew out to about 60 to 70 basis points. And it's a little bit more spiked than what's happening, or a bit more concentrated on a few days than what happens for the Treasury OIS spread, but it's sort of roughly happening in the same period. Okay, and then the model also predicts that the yield curve should have steepened, and this is also what we see in the data during that period. Yeah. Okay, so this is what we have about 2020. The model also has something to say about 2008, and 2008 is in a way interesting in the sense that a lot of things that happened in 2008 were similar to 2020, but with the signs all reversed. Yeah, so for example, if you look at the buying and selling behavior of foreign investors in 2008, they were all buying during these critical months of late 2007, early 2008. There was a big buying pressure from foreign investors. The Federal Reserve, instead of increasing its treasury holdings, was reducing its treasury holdings throughout the crisis. Yeah? So this looks like there was a large treasury demand shock that the Fed eventually helped to accommodate. Yeah? One way in which the Fed helped to accommodate this was by introducing the Term Securities Lending Facility, the TSLF, in March 2008. And with that facility, dealers could basically take non-treasury collateral, give it to the Fed, and get treasuries in return. Yeah? And you can see why the dealers might have wanted that, because they actually entered the crisis with a big net short position in treasuries. And so again, this is the opposite of what's going on in 2020. In 2020, dealers were long and getting more long. In 2008, dealers were short. Our model can help understand what happened in 2008 with one twist, which is the friction that is relevant is a different one, because the dealers here are not long, they are short. The relevant friction is a short selling cost. Yeah? So if there's some cost to, for example, failing to deliver, which would be just doing a naked short sale, or equivalently, we could have a securities borrowing friction that makes short selling costly. With that introduced in a model, and then given a treasury demand shock, our model basically gives predictions about the convenience yield of treasuries and repo rates that are kind of consistent with what one sees in the data. And so, for example, in 2008, then, according to the model, treasury repo rates should be lower than the risk-free rate, and this is what one tends to see during that period. And the treasury yield should be lower than the OIS swap rates. And that's also what we see there and what I'm going to show you. Yeah. So in 2008, then we had a convenience yield, not an inconvenience yield. And the negative holding cost that this implies that treasuries have basically compensates in the model the dealers for the short selling cost. Yeah. Okay, so here's the left-hand plot is the treasury OIS spread in 2008. And you can see that throughout this period, it was in a negative territory, about -40 to -50 basis points. Yeah? So the signs flipped relative to what we had in in 2020. And eventually it went back to zero after the Fed had a bunch of programs that increased the supply of treasuries in the market. So the Fed was facing a very different problem back then from the one it's facing now. The final part of the paper is where we just look at a full period from 2008 to now, and we look at the evolution of these rate spreads, the repo spread, and the Treasury OIS spread over that period. So let me start with the right-hand plot, the Treasury OIS spread. So it started out being very negative at the start of the crisis before the TSLF program of the Fed was introduced. It shrank a lot when the Fed introduced the TSLF. It moved positive after the financial crisis, and it became bigger after the SLR regulation was introduced. So this is an indication that the relevant friction here shifted from that short sale friction slowly over towards the balance sheet constraint being the relevant friction. And we see something similar for the repo spread, but for the repo spread, we don't have good data for at the same kind of frequency for the financial crisis period. So that's why we only have the two last periods there. Okay, so let me conclude. So what I've shown you is some evidence that the intermediary sector in March 2020 struggled to absorb this negative demand shock that some large owners of Treasury apparently had. And a model with dealer balance sheet constraint goes some way in explaining a bunch of things in the data that were happening at the same time, like the steepening of the yield curve, the emergence and rise of inconvenience yield of Treasuries, the triparty GCF triparty repo spread, and then also an explanation why purchases of Treasuries and also the exemption of Treasuries from the SLR that the Fed introduced in March, in April of this year, why this helped basically to reverse these kinds of effects. What is still open is a very important question, which we don't know the answer to, is what motivated some large holders of U.S. Treasuries to sell, and this in our view is a big question going forward, and this relates to some of the thoughts that Ricardo put out in his introduction at the very beginning of the session today.
Okay, great. Thanks a lot, Stefan. Nina, would you like to share your slides and start the discussion?
Yep. So hopefully you guys can see my slides now and can hear me well. So thanks for inviting me to discuss this paper. It was very interesting for me to read, both because these sorts of questions are questions that we have been working on for a few years now. So the impact of post-crisis regulation on liquidity provision in general, but also bank liquidity provision in particular. But also, of course, because being at a central bank during this time, we think about these questions in this particular setting a lot. Before I start with the actual content of my discussion, let me say the usual disclaimer that these are my views and not the views of the bank or of the reserve system. So, okay, so just to give you an overview of the types of things that the paper covers, but also what I'm going to be talking about, the basic idea is that post-crisis regulatory changes increase recognition of repo and reverse repo positions for regulatory leverage for bank holding companies in the US. Now that has a number of implications, such as changing the willingness of bank holding companies to take on leverage and to provide leverage to clients. It also implies that repo funded positions become more balance sheet expensive, so potentially implying that bank holding companies are going to require more compensation for absorbing flows in securities that are repo funded. And one thing that I want to point out right at the beginning is that here it really is about the whether a position can be repo funded or not.
And so to some extent, this overall story is not just potentially about treasuries, but about other assets such as corporate bonds that when held on bank balance sheets or when held on hedge fund balance sheets tend to be repo financed. So Stefan showed us a number of dislocation metrics for the dislocations in March in treasuries. I'm going to show a different metric, which is the futures implied repo rate for the cheapest to deliver treasury into the futures contract. The basic idea is that usually that spread should be pretty close, that implied repo rate should be pretty close to the actual repo rate on treasuries. But during March, we see that rate become very volatile. And in particular, it first becomes volatile for the 10-year bond, for the 10-year futures contract, excuse me, which is this greenish line. Then it becomes volatile for the 5-year and finally for the 2-year. So if you think about this maturity cross-section, essentially you see a bigger dislocation early on in longer maturities, which then if we split what actually happens to primary dealer balance sheets, again, by type of instrument and by maturity of the instrument, we see that the absorption that Stefan was talking about primarily happens in terms of coupons with maturities bigger than 6 years. So to explain what I'm actually plotting here, so if we start with the signed position plot on the top left, the values above 0 are the long maturities, the values below 0 are the corresponding short maturities. And in this plot, it's a little bit hard to say whether it's the longer maturities that move more or the shorter maturities, which is why I'm also giving you, or the short positions and the longer maturities, which is why I'm giving you the net position plot below. And here again, you can see very clearly that during this March period, what was happening is that dealers had to absorb a lot of supply of coupons above 6 years. That was somewhat offset by them being able to shed some treasury bills. And once the Fed interventions happened, that dynamic sort of reversed. So you saw an increase in the bill holdings by primary dealers and a corresponding decrease of longer maturity holdings. Now, the other piece of this puzzle that is, again, important in the supplementary leverage story is what happens in terms of repo financing. So again, on the top right, I'm plotting the repo and reverse repo position. So securities lent means a repo position, security borrowed means a reverse repo position. And you can see that there is also a dichotomy in terms of the maturity of the repo contracts, where we do see an increase in the overnight repo positions, but we also see a corresponding decrease in the term repo positions at the same time. So what I want to do in the rest of my discussion is drill down a little bit into what types of primary dealers are actually accounting for these changes in positions and these changes in repo financing. And in particular, I'm going to use the underlying data from the Effort 2004 report, which actually gives me all of this information at the dealer level. And I'm going to group dealers into 5 categories. So first, I'm going to identify dealers that have US banks. For those that have a US bank that is subject to the supplementary leverage ratio, I'm going to group them into tercels based on their supplementary leverage ratio as of Q4 2019. So the latest quarter before the start of the crisis, where the bottom tercel is going to be low reported SLR. So think of this as being the most constrained. Then I'm going to have some dealers that do have a US bank, but the US bank is not subject to SLR. And finally, I'm going to have a fifth category of primary dealers that don't actually have a US bank at all. And corresponding to what I just showed you with the flows being concentrated in the longer maturity coupon bonds, I'm going to think about changes in positions for long versus short, where for these purposes, I'm going to define long as being 6 years or more. And then I also want to look at what happens in overnight versus term securities financing. And as I go through these results, what I want you to keep in the back of your mind is that the basic hypothesis we're thinking about is March Treasury dislocations happened because constrained dealers had to absorb this net customer flow or customer supply shock. So let's start with the positions data. Again, above the zero line, I have the long positions. Below the zero line, I have the short positions. And each line in the graph corresponds to, again, a different group of dealers. So the bright blue, which you will see is on top in all these graphs, are the dealers whose bank holding companies fall in this bottom tercile of the supplementary leverage ratio. Then moving through the two shades of gray as we go down in the supplementary leverage terciles. Finally, the pinkish color are the dealers that have a US bank but are not subject to the supplementary leverage ratio. And finally, the darker blue line are the dealers that don't have a US bank. And so ignoring for a minute the dealers that don't have a US bank, what we do see is this nice ranking where as you go from a dealer that is not subject to SLR to dealers that kind of have a big SLR cushion and all the way up to dealers in the bottom tercile, you see bigger increases in these positions. And in particular, those increases are, again, concentrated in these securities with a 6-year maturity or more. You may be wondering whether, since those dealers are also starting at a higher level of position, whether they really had to absorb more. I can tell you that you can do this plot in terms of percentage changes relative to January 2020 positions. And again, you get the same ranking. Now, the other thing that's sort of interesting is that if we look at increases in long versus short positions, again, for long positions, for positions in coupons with more than 6-year maturity, we see increases on both sides of the balance sheet, although again, the increases in long positions are bigger. So on net, those dealers absorbed more longer term maturities. Interestingly, though, for the maturities below 6 years, you actually see that you do see a differential increase in short positions and coupons. So maybe there was a little bit of a portfolio rebalancing, again, especially for dealers most constrained by SLR happening and them trying to rebalance their new long positions in the 6-year with short positions in the below 6-year line. One thing to point out is that dealers without a US bank holding company act like they're somewhere in the middle of this SLR range, which potentially suggests that beyond straight regulatory leverage considerations, there were also risk management considerations playing a role. Again, going back to what Ricardo said at the beginning about maybe these longer term bonds just becoming more volatile in recent periods. So corresponding to this increase in positions in long bonds by more constrained dealers, we're also see bigger increases in overnight repo financing by those dealers. And again, ignoring this no US bank category, you do again get this very nice spread of for the bank, excuse me, for the dealers that are not constrained by SLR, their repo positions essentially don't change. As their bank becomes more SLR constrained, they corresponding to them having to absorb more treasuries, they wind up financing more of those in overnight repo. Now, what's interesting is that in term repo, you actually get a little bit of the opposite picture. So the dealers whose banks are most constrained by SLR seem to be engaged in a lot more reverse repo activity during this period. And so then there is a question as to whether this dichotomy between overnight and term repo tells us something about either the actual constraints that are being faced by dealers, or what do dealers think about the dislocation. So you can imagine that if dealers expect dislocations to be short-lived, they're willing to finance those positions in overnight repo, knowing that both the positions and the repo financing can go away after a couple of days. Or perhaps they are also worried about implications for things like the liquidity coverage ratio, where the longer is your financing maturity, the more liquid assets you have to put up against that. The last thing I want to point out is that so far I've shown you what dealers wind up absorbing. Now, of course, what dealers wind up absorbing is an equilibrium outcome between what gets sold to them and what they're actually willing to hold. So a way of trying to understand how much of the differential behavior by more constrained banks is coming from their customers versus what they do is to actually look at intermediate volume, again, at the dealer level or the dealer category level. So intermediated volume is, here I'm going to define as the ratio between transactions with others, so think non-dealers, and transactions with inter-dealer broker. And the basic idea between intermediated volume measures is that when you have low intermediated volume, you need to have more inter-dealer transactions to find the ultimate customer or to find the ultimate holder for the securities that enter into the system. Now, what you can see here is that unlike the previous two sets of charts that I showed you, there are similar decreases in intermediated volume across the dealer categories. And so what that tells you is that all dealers found client volume problematic to absorb. So it's not like a more constrained dealer could have found a less constrained dealer to actually pass through those securities. And instead, they wound up having to absorb those securities themselves, which in the world of the model, and again, like in the world of limits to arbitrage, you think leads to bigger dislocations between markets.
Nina, would you like to kind of wrap up?
Yes, I will skip there. Just to summarize what I've shown you, so again, micro efforts 2004 data is going to be consistent with the basic hypothesis of large volumes of customer flows being absorbed by most constrained dealers. Now, one thing that is a little bit puzzling about this particular episode is that if you look at other markets, such as the corporate bond market, you don't see the same positions dynamics by more constrained dealers playing out in those markets. So beyond the supplementary leverage ratio, which is applicable to both treasuries and corporate bonds, there is something about the treasury market in particular that played out different in March. And I think it would be interesting for the paper to actually think about that.
Okay, great. Thanks a lot, Nina. And before I let Stefan answer, I wanted to tell all the audience, please raise your hands in the raise hand feature if you want to participate in the discussion. Otherwise, we'll, after the questions, we're going to go to the Wonder platform. Stefan, please.
Yeah, so let me just thank Nina for a fantastic discussion. This is very interesting, and I also agree with the conclusion at the end that it would be nice to study this jointly with the corporate bond market and other assets to see, sort of get an overall picture of what's going on. We are focusing right now on treasuries only, but I think the end goal should be to get a broad understanding of all of how all these pieces fit together. So I agree.
Okay, so there's a number of questions.
Mm-hmm.
I don't think we're going to get to all of them. So let me ask the first question from Martin Schneider. Martin, do you want to ask from Stanford? Do you want to ask your question?
Sure. Yeah, so Stefan, I'm very sympathetic to the story, and all these quantity implications are very cool. But I was thinking kind of the other thing that happened in March was that people were still learning about whether the recovery would be V-shaped. So the question would be, are there survey forecasts of nominal growth that just through a simple expectation hypothesis channel might lead to this type of things?
So we haven't looked at this specifically yet, but let me just say, and this, what I'm saying now also actually applies to another question that Anindo Sarkar asked about whether a change in the covariance between inflation and output could play a role here. I think all of these stories would not say anything about the inconvenience yield, the Treasury OIS spread, right? This would, the story you have in mind would mean that the Treasury curve should shift and the OIS curve should shift, but there's no reason why there should be a big widening gap between the two. And so that's why I'm skeptical that, this is the story.
Okay, the next question is from Sebastian Anfonte from Fed Board. Sebastian, please go ahead.
Hi, very, very interesting paper and very interesting discussion. I guess in reference to Nina's final question, what was the difference between the corporate bond market? One thing comes to mind is the heavy reliance of repo and reverse repo in the treasury market relative to the corporate bond market. I don't know if that's something that we could think about, sort of how actual important the funding markets are and what contracts are used.
That is a possibility. This is one of the differences. So it could be, but I'm at this point not sure whether this is the key difference or there's something else.
Okay, so the next question is again from Pierre-Olivier Voile from UCLA. Pierre-Olivier, please.
Hi everyone, great paper and discussion again. I wanted to just follow up on Nina's observation about heterogeneous response, and if you had any thought about the type of underlying heterogeneity that could explain that. I mean, I guess the first thing that comes to mind would be heterogeneity and risk aversion, but
right. And this is actually an important point. So as Nina was showing these charts, I was thinking about these patterns, and it's very interesting. But it's not easy to figure out exactly what it means, because there must be a reason why dealers are initially different, right? Why initially already some dealers are close to the constraint, others are not. Why some are big, some are not in treasuries and so on. And so I think you're right. One would need a model that builds in, relevant sources of heterogeneity, risk aversion, and other things to see whether one could match that cross-sectional dispersion that one sees there in these charts, but it's not very straightforward. So I don't want to speculate on this.
Thank you.
Okay, great. So for the last question, let's ask Andy Atkeson. He had a question. Andy, please go ahead.
So thank you. I mean, I think about the history of previous crises. You go back to the 19th century when Europe, or early 20th, when Europe would have a war, they'd pull money out of the US. And given that in this case, COVID hit Asia first, would the dynamics be different than 2008, that you would have a reason people wanted to sell treasuries, that they wanted basic in Asia to pull back? Is there any evidence that those types of sales occurred?
Yeah, so at least the data we have seen so far, it's hard to, drill down at this level of detail to see whether this is going on. So for example, there's a huge sale of, foreign investors from the Caribbean, but we have no idea what's behind Caribbean. These are obviously, this could be, Asian investors, this could be hedge funds, this could be someone else. So it's difficult to tease out who exactly it was who was selling there. So I think this is a big question on the table, and it's possible. I mean, maybe in Asia, they desperately wanted dollars and dollar cash, not in the form of treasury bonds, and the only way to get that cash buffer at the time was to sell the treasuries, and maybe the swap lines eventually helped to alleviate this, but it's a possibility. But we couldn't find any good data on this yet.